The federal budget has been released, and while headlines focus on politics, what actually matters is this: how these changes impact your position, your investments, and your long-term strategy. Today, we're cutting through the noise and walking you through the key updates and, more importantly, what you should be thinking about right now. So we're focused on the 6 key changes that we've identified should be on your radar. Point one is to do with the capital gains tax. A structural shift is being proposed here. The current 50% capital gain discount, one of the most valuable planning tools, is proposed to move to an indexation style model with a minimum 30% tax on capital gains from 1 July 2027. Importantly, gains accrued before this date are expected to be protected under transitional rules. So the planning takeaway is that this is not an immediate issue. This is something to factor into long-term investment decisions from now. Point two is the negative gearing. So the changes for future property purchases. So existing investments remain grandfathered. However, for newly acquired established properties after 12 May 2026, losses may only be offset against property income, not your salary. So the planning takeaway is that this will impact future property acquisition strategies, particularly for high income earners. Point three is the $1,000 standard deduction. It's more intended to be a simplification for individual taxpayers. So from 1 July 2026, eligible taxpayers can claim a $1,000 automatic deduction without any substantiation. The planning takeaway is that this won't change strategy at a high income level, but it does simplify compliance for those with lower work-related expenses. Point four is the personal tax cuts. Modest but relevant. The tax cut on income between 18,201 and 45,000 will reduce progressively to 14% by 2027, along with a $250 offset. The planning takeaway is that it's an incremental benefit, but nothing material. Okay. Point five is the instant asset write-off, particularly for small businesses, $20,000 write-off now being confirmed as ongoing. The instant asset write-off becomes a permanent feature for businesses under $10 million turnover. The planning takeaway is it gives us a bit of certainty rather than trying to rush things before 30 June. It allows us to better plan for these capital expenditures coming forward. Point six is discretionary trust. It's been left as point six for a reason. In our opinion, it is the most potential major change ahead. So from 1 July 2028, a proposed minimum 30% tax rate on trust distributions may apply. And the planning takeaway is that it may impact long-term planning for business owners and family groups, and early review is critical. Many of these measures are still proposed, but the direction is clear. The key question isn't what changed, it's whether your current situation, investments, and strategy are still fit for purpose. So this is exactly where proactive advice matters. If you'd like to discuss how these proposed changes could affect your situation, we would love to have a chat. Our view is that the budget is less about immediate relief and more about chasing long-term rules around wealth creation, property and tax planning, but the broad message is clear. The government is shifting incentives away from passive investment structures towards wage earners, productivity, and areas it sees as more economically constructive. That broadly aligns with what leading economists have said. While some of these measures are being framed as reform, the package feels more like revenue-raising exercise than genuine structural change. It may improve the government's tax take, but it does very little to solve the bigger issues around affordability, productivity, or long-term economic efficiency. So the real takeaway for clients is this: don't react emotionally, but pay attention to the direction of travel. If these measures become law, early planning and structural flexibility will matter more than ever. Bye for now.